Was the Fed right all along to get as hawkish as they did in December? Bond market certainly thinks so. We're going to find out a lot more in the next 24 hours. That's what we're going to focus on here on Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we have what is possibly the biggest piece of economic event risk in our sights for today. Over the next 24 hours, we are going to get minutes from December's fateful policy decision. And then the markets are going to close on Thursday for the observance of former President Jimmy Carter's funeral. So there's going to be no opportunity for markets beyond Wednesday to pre-position for what is then going to be a piece of major economic data by way of the U.S. jobs report on Friday. So this makes for an interesting setting of the table here because, of course, what we have seen here today is something of an ominous omen. So we're going to take a look here and break this down and see where we might be going, and at the very least what the moving parts are in this machine. So let's consider first what we have here from that December policy meeting. As we can see here, courtesy of Nick Timmeros at the Wall Street Journal, and of course the Federal Reserve Board itself. This is the statement from December, and we can see the adjustments from November's rhetoric, and it isn't significant, to say the least. Really, the key here seems to be the little bit in the third paragraph where the committee decided, of course, to cut rates by another 0.25%. And in considering the extent and timing of additional adjustments to the target rate, the committee will be, as ever, mindful of the economic outlook, et cetera, et cetera, et cetera. And so really the key here seems to be that what we have is an adjustment to the timing component. And the main sort of market moving bit is in this set of updated economic forecasts that the Fed published alongside that statement. So we can see right here, the Fed in September said that it was going to take rates to 4.4% by the end of 2024. It did this with only 2 meetings past September left on the calendar. So it went from 5.4 down 50 basis points and said they're going to 4.4, that is a cumulative 100 basis points, with only November and December left. So it really wasn't a stretch to say, okay, well, you want to go down 100 basis points, you want to go down 50 up front, you have 50 left, there's 2 meetings, path of least resistance is a standard quarter point cut at each of those meetings, and of course that's exactly what we got with December's move. Now, for 2025 and beyond, that's where things get interesting. Here's that extension of the timing that was alluded to in the statement. In September, the Fed thought it was going to cut by another 100 basis points this year, from 4.4 to 3.4. Now that ends up being the terminal rate in 2026. So the Fed takes an extra year to get to the same destination. It's cutting here, but the pace has slowed significantly. Moreover, before it was expecting to get to 2.9 in 2026. So consider this not only a reduction of the number of cuts that are expected for this year, but an extension of the entire timeline where cuts are coming, but they're slower, and they're slower across the forecast. Notice, we were expecting 2.9 in 2026. We're not even expecting to get that low by 2027 in the updated forecast that was there in December. So the Fed has not only said fewer cuts, it said all of the cuts for the entire forecast are going to come at a slower cadence. Now, by the time the Fed does this, the markets have already adjusted to a more hawkish setting. So here was September, where they issued those very dovish forecasts that we just looked at, 100 basis points last year, 100 basis points this year. We can see by November, this is the big dash line here. This is the meeting in November, November 7th. The Fed has already, in the eyes of the markets, established for itself a strong market signal for something less dovish. So looking at the implications in Fed funds futures, we already moved from sub 3% closer to 4% as the terminal rate for where policy is going in 2025. And we can see here, since then, the December meeting didn't really change things very much, and the current setting of policy, not very much different from November or December. So really the big adjustment here was September to November, as the market said, yeah, okay, this is too dovish, you're going to have to go the other way. And we can see why that was. If we look at the way that economic data was performing, and we've talked about this at length, so we won't dwell on it too much here, we can see that by the time the Fed delivers September's very dovish announcement, that's here, U.S. economic data has started to improve relative to forecasts. And the markets say, okay, so you're cutting into an economy that isn't cooling but warming. So this means your cuts are going to be inflationary, and you're not going to be able to do all of what you're saying. You're going to need to curb how many cuts you're going to do. Otherwise, you're going to let inflation out of the bag. And so what we then see from September onward is inflation expectations rise as they are baked into the bond market. These are what are called break-even rates. They are the difference between nominal and real bond yields. Of course, that gives you the adjustment to inflation expectations that gets you from nominal to real, because of course real is nominal minus expected inflation. So if you take the yields difference there, you end up with what that expected inflation coefficient is. That's these break-even rates. And we can see from September, when the market goes, okay, the Fed was too dovish, we get a rise in inflation expectations. We get a rise in bond yields. The 2-year, the 10-year, they go up. The yield curve steepens. The dollar goes up. Textbook. And so by the time the Fed does this update in December that we're going to get these minutes for, the move has already occurred. As we can see here, most of the change happens by November, and indeed, here's the adjustment to inflation expectations going into November. By the start of the month, it's already there. That, needless to say, lines up with this here. And so when you look at what then happens, you get steady inflation expectations. The dollar manages to keep going up. Yields manage to keep going up. But the overall Fed policy structure and the impetus for it from inflation expectations, that's holding relatively steady. If we look at where we are then overall, we can see here is that significant adjustment. We went from 138 basis points in rate cuts over this and next year being baked in as the Fed was getting ready to make its September move, to now less than half that. And as we can see here, the markets are actually even more hawkish already in the pricing than is the Fed. The Fed expects 50 basis points this year and next. See that right here, from 4.4 to 3.9. That's 50 basis points in cuts. From 3.9 to 3.4, that's another 50 basis points in cuts. The markets are much more modest. 36 basis points for this year, 22 for next. So maybe a cut and a half being baked in for this year, and maybe one for next. And that's it. Now, we've talked at length about how the Fed was more dovish than the markets thought reasonable in September, so there was this adjustment. This is it. And the reason for it was that the data was already warming when the Fed made its move. It was a similar story in the way that December happened, except in the opposite direction. Right here is the Fed's December move, and of course, by then we can see the economy is already cooling. So perhaps the signal there was September, but upside down. So if in September, the markets had to adjust up yields and the dollar and the yield curve because they were fading the Fed's dovishness, here the dynamics of economic data flow suggested it was time for the markets to do the opposite, to fade the Fed's hawkishness by saying, well, the economy is already cooling. No, you're not going to be this modest. You're going to need to cut more. And that was what could have been were the data to comply. But when we got today's ISM service sector report, the story was quite different indeed. Take a look. So we have here expectations that the manufacturing sector was going to shrink again, and these are numbers from last week, but that it would shrink faster than it ultimately did. 48.4 was expected, 49.3 was the realized, but of course, we've been in a bit of a range for manufacturing activity growth going back to early 2023, so maybe that wasn't a big deal. But today we got the service sector numbers, and of course, this is the lion's share of the U.S. economy, and the lion's share of inflation too. Overwhelmingly, inflation is now locked in the service sector, excluding energy and food. That inflation isn't really much to speak of. And so when we look at what this was, this is really the essence of what the Fed is looking at. If it's going to cut rates, if it's going to reason that the U.S. economy is cooling, as this might suggest, at least in relative terms, then we would need to see this show up in this important part of the economy, and the result was anything but. Another upside surprise, 54.1 versus 53.3 expected. So not only did the U.S. economy return to a faster clip of growth than the 3-month low that we saw in November, but it returned there with more vigor than anticipated. The November number, just for reference, was 52.1, so the expectation of 53.3 was already looking for an uptick, and if the data was starting to surprise lower, a weaker number would have supported the idea that the Fed's off sides. But this number is meaningfully stronger. Indeed, if we take a look at the internals of the report, they are still more hawkish, and in particular, the focus here on the price component. What we see here is a very strong reading of 64.4. That is the highest inflation reading within the ISM services survey. And again, this is where inflation lives at the moment. This is what the Fed needs to bring down if it's going to cut rates with gusto. This is the highest reading since September 2020, or since February, 2023. So this is a very elevated reading. The last time we got anywhere close to this, in fact, or not quite as high, 64 even, was January of 2024. So we're looking at a significant inflationary pickup. Moreover, the rest of the internals not looking all that bad. Employment basically unscathed, 51.4 versus 51.5 in the prior month. New orders, though, growing faster, 54.2 versus 53.7. And you can see that here. Steady employment, uptick in new orders, sharp uptick in the price component. Now, with this in mind, we get seemingly support for what the Fed is talking about. Moreover, from the November meeting minutes. This is the preceding meeting. Since that time, of course, again, as we look at the structure in the markets, there hasn't been a big adjustment. The big move was September repricing into November. From November, the markets have thought things have been basically steady. So what did the Fed say? Well, the November minutes, one of the key takeaways here comes from that very first quote that we have on the screen. Many participants noted the volatility of recent economic data and highlighted the importance of focusing on underlying economic trends. Second point, almost all participants judged that though month-to-month movements would remain volatile, incoming data generally remained consistent with inflation returning sustainably to 2%. So, what does this tell us? First and foremost, it tells us that with the kind of ISM data that we have today, we don't really have a reason for the markets to doubt a hawkish Fed. Of course, minutes from the December meeting are inherently backward-looking, but as we can see from these quotes, it's not exactly a stenographer's readout of what was said at the conclave. It's an editorialized summary. And in saying many participants, or almost all, or a large majority, as opposed to a few or some, you get a sense of how much consensus there is behind a given statement. So what we have here then is a Fed that is reluctant to over-extrapolate short-term economic data. And although the economic data was already cooling from mid-November into the policy announcement, with that kind of rhetoric, it's unlikely that the Fed made much of this for now. So the bias probably continues to tilt in a cautiously more hawkish direction as the forecasting suggested and as the repricing in markets anticipated. And with the ISM numbers looking like they are here, and especially the price component here, it seems likely that the market takes that assessment at face value and says, okay, so the Fed was relatively hawkish. We knew that. The Fed is reluctant to jump, as the economic data says, in the near term, and wants to take a more gradualist approach. Okay, that's probably going to be reiterated. So we probably have the same kind of Fed in these minutes as the November minutes suggested. And with the ISM data, there's really not a big reason to say the Fed is offsides or was offsides in December. Rather, the Fed might have, in these ISM numbers, bought themselves more time for the data to go their way. And so perhaps what we have then is a repeat in response to these minutes of what we just saw today in response to the ISM. And the story very clearly is that the markets are getting uncomfortable with what rates are doing. S&P down 1.08%, NASDAQ down 1.69%, rates up across the curve, 2-year up almost 0.6%, the 10-year up 1.36%. Interestingly, in this environment, gold wiggled higher a little bit, which is a little bit strange for a more hawkish sort of readout elsewhere. See what that means. Perhaps over the coming days, but the US dollar is clearly stronger here in response. So at least that is firmly in confirmation of what we're seeing in yields and indeed in equities, because the dollar does tend to be a beneficiary oftentimes of equity market weakness. As capital liquidates and goes to cash, it is the dollar with its unrivaled liquidity that is the beneficiary of investors cashing out most usually. Incidentally, the fact that the yen is also down against the dollar, that implies that it is, in fact, yields motivated because, of course, the yen yields next to nothing even after the handful of baby rate hikes from last year, because, of course, rates there are still close to zero. So when global interest rates, as piloted by the Fed because of the dollar's ubiquity in global commerce and therefore global borrowing, as global borrowing costs go up, you tend to see the yen weaken because, of course, this encourages people to borrow cheaply in yen to buy higher yielding alternatives. At the same time, when you get risk aversion, like what we see in stocks today, you get people encouraged to divest of complicated positions where they're seeking to extract yield by borrowing yen and buying something that yields more, and tends to have them cover those kinds of things. And so we get a yen today that's responding to the moving yields, but where the dollar is not as strong as it was, let's say, against the euro, where you don't have this carry trade unwinding dynamic battling it out with higher yields for yen influence. So we can clearly see that it is the yields story winning out, and we can clearly see that it's presenting itself across markets. So if we were to have a situation where we are looking at inflation that's looking stickier and rates that are going down slower, because the FOMC minutes sound hawkish and the ISM makes us believe that messaging, then more of the same might be on the docket. That is, weaker stocks, higher yields. Interestingly, crude oil today rallying with yields and the dollar, as if to say that it is looking like a vehicle for more demand in a heating up of the economy after those ISM figures especially. And one way that to read the rise in gold might be that the Fed is perhaps not hawkish enough, that they're going to slow walk it as the economy heats up and miss the boat, and that yields need to be even higher. Though, of course, it is a bit strange that gold has gains when both yields and the dollar are signaling that it shouldn't. Something to watch in the days ahead. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow. I am typically on with Victor Jones on Tuesdays this year for the price of truth, though I think we are off today. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.